Welcome to the Deep Dive, where we pull out the key insights from the sources you need to know about. Today, we're tackling a really fascinating story. It's about CorMedix Inc., ticker CRMD, a company that, honestly, defied some incredible odds. We're talking a decade of regulatory battles, major hurdles, but now they've got this single, potentially revolutionary product, and they look poised to, well, really shake up a multi-billion-dollar market. It's more than just another small-cap biotech story. You start looking at it and you see these hints, these hallmarks maybe, of what could become one of those Buffett-style compounding machines. And the timing for this deep dive, it really couldn't be better. As we're recording June 23rd, 2025, CorMedix is seeing some significant action pre-market. Why? Well, a press release just dropped. They've expanded a major commercial deal with a key large dialysis organization, an LDO, for their main product, DefenCath. And this isn't small expansion. They're targeting at least 50% more patients now.
Yeah, that's a big jump. It screams accelerating adoption, Demand seems stronger than even they might have anticipated.
Exactly. And they've already bumped up their Q2 2025 sales guidance because of it. They were looking at $31 million. Now it's $35 to $40 million.
Right. That kind of rapid shift definitely warrants a closer look.
Absolutely. So we're going to unpack exactly what's going on, what it means for CorMedix moving forward. Part 1, the foundational pillars of CorMedix. Okay, so where do we start with a complex story like this? Let's kick off with Chapter 1. Business analysis. The DefenCath engine. This really feels like a new era for CorMedix, doesn't it? After, a decade-plus journey, so many setbacks, regulatory issues, even manufacturing headaches.
A tough road.
So the big question is, have they finally cracked it? Have they unlocked this huge market with just one product, DefenCath? We're seeing this shift from burning cash in R&D to actually making profits commercially. It's a massive inflection point. We're digging into all of it based on info right up to today, June 23rd.
Okay, so fundamentally, CorMedix has this super focused model. It's all about biopharma, and really it's all about DefenCath. Revenue comes from direct sales, primarily into hospitals, inpatient settings, and also outpatient dialysis clinics. That really started ramping up in 2024.
And those big contracts are key, right? Like the one announced today.
Exactly. Those large-scale, multi-year deals with the LDOs, the large dialysis organizations, they're absolutely critical. Today's news just hammers that point home.
So tell us about DefenCath itself. What is it?
Right. So DefenCath, it's their proprietary formulation. It combines two things: taurolidine, which is antimicrobial and antifungal.
Okay.
And heparin, which most people know as an anticoagulant. It works as what's called a catheter lock solution, or CLS. Basically, it's put into a central venous catheter, a CVC, between hemodialysis sessions.
That's its main job.
Its FDA-approved job, which is crucial, is to cut down on catheter-related bloodstream infections, CRBSIs, for adult kidney failure patients on chronic hemodialysis. And the clinical data is, well, it's pretty striking. The main study, LOCK-IT100, showed a 71% reduction in these infections compared to the usual standard of care.
Wow, 71%. That's significant.
It's huge, a massive impact on patient safety. And that clinical power, plus its regulatory status, gives CorMedix this uniquely powerful market position. They are, and this is the key takeaway, the first and only company with an FDA-approved antimicrobial catheter lock solution here in the U.S.
First and only. Okay.
That's not just a small edge, it's a massive first-mover advantage. Before DefenCath, the options were basically heparin alone, which doesn't fight microbes, or these kind of risky off-label compounded antibiotic solutions.
Right. Not ideal.
Not ideal at all. So even though CorMedix is still technically a small cap, market cap just under $1 billion, they've essentially created and now own a new FDA-backed standard of care.
So what's the value proposition then? Who wins here?
It's multifaceted, really. CRBSIs are incredibly dangerous for dialysis patients, costly too. Leads to hospitalizations, serious complications, sometimes even death. DefenCath offers a safe, effective, and again, FDA-approved way to prevent that.
So patients are safer.
Definitely. Huge reduction in risk for them. For doctors and hospitals, it means better outcomes, fewer people ending up back in the hospital.
Makes sense.
And for the payers, think Medicare insurance companies, yeah, DefenCath costs something up front, but preventing those severe, expensive infections saves a lot more money in the long run. It's a compelling case all around.
That lays out the core product really well.
Yeah.
So how does it fit into the bigger picture? Let's look at the industry analysis. This market for treating CRBSIs, it's already pretty big, right? Around $1.5 billion back in 2023.
That's right. And it's growing. Expected to hit maybe $2.5 billion by 2033. That's like a 5% growth rate per year.
And that's driven by, what, aging populations? more long-term catheter use.
Exactly. Both those factors are pushing demand.
But the really exciting part, I think, is how they're looking beyond just that core dialysis market.
Yeah.
This expansion of the TAM, the total addressable market. They're running a phase 3 study right now for DefenCath in TPN patients' total parenteral nutrition.
That's a big one.
Huge. That TPN market is estimated at, what, $500 to $750 million?
Yeah, somewhere in that range.
And if they get approval there, management thinks it could add another $150 to $200 million in peak annual sales. I mean, that basically doubles their long-term potential, right?
Potentially, yes. It's a massive opportunity. And then you add the planned pediatric studies for next year, 2025. It just keeps expanding the possibility.
Okay, so TAM expansion is key. What about competitors? You said they're the only FDA-approved one.
Right. So their main competition isn't really another product like DefenCath because, well, there isn't one. They're fighting against the status quo, the entrenched but frankly suboptimal ways things have been done.
Like just using heparin.
Exactly. Standard heparin locks no antimicrobial action, or those compounded antibiotic locks we mentioned. Those are used off-label, they contribute to antibiotic resistance, a huge global health problem, and they lack that consistent quality and FDA oversight.
So DefenCath's approval is a massive shield.
It's an incredibly powerful competitive shield. It's the only FDA-approved non-antibiotic antimicrobial CLS. It's a classic innovator disrupting an older, less effective practice.
Which brings us neatly to the regulatory side. You mentioned the approval journey was long.
Oh, it was. Very long, very challenging. They finally got that NDA approval on November 15th, 2023.
But there were some special designations involved, right? That helps create this moat you hear about.
Absolutely critical. They got Fast Track designation, which helps speed things up. But the big one is QIDP status, Qualified Infectious Disease Product.
QIDP, okay, what does that do?
That grants an extra 5 years of marketing exclusivity, on top of the standard exclusivity for being a new chemical entity. So combine those, and DefenCath has 10.5 years of statutory protection from generic competition.
10.5 years.
Wow.
And potentially longer if they get pediatric approvals.
So that regulatory exclusivity is one layer of the moat. What else protects them?
It's multi-layered, really. You've got the regulatory piece, that 10.5 years. Then there's intellectual property. Their main patent runs until April 2042.
Okay, long runway there.
Very long. Then you have the sheer cost and risk of clinical development. CorMedix themselves hit 2 FDA rejections, 2 CRLs, remember. That's a huge deterrent for anyone thinking of trying to follow them.
Good point, a cautionary tale.
Definitely. And finally, there are the commercial relationships and switching costs. Once a hospital or an LDO integrates DefenCath into their protocols, updating IT, training staff, getting committee approvals, it's sticky. They're less likely to switch back.
So, regulatory exclusivity, IP, high development hurdles, sticky customers. Exactly. It all adds up to what's effectively a government-sanctioned temporary monopoly. And that's why, a lot of the current valuation is based on that core hemodialysis market, but that TPN trial. It's like this heavily discounted but potentially massive call option on future growth baked in.
That's a really clear picture of their market position. Okay, let's shift gears. Let's talk about Chapter 2. Management evaluation, navigating from setback to success. You often find out how good a management team really is when things go wrong, right? In a crisis.
That's usually the true test, yes.
So looking at CorMedix's leadership, the CEO, Joseph Tedisco, came on board in May 2022. He had that commercial background they really needed at that stage.
Right, pivoting from R&D to sales.
And the CFO, Dr. Matthew David, even stepped in as interim CEO during a critical time. The team seems pretty stable, average tenure around 3 years, which feels like a positive sign through all this change.
And their defining test, no question, was dealing with those 2 FDA complete response letters, the CRLs.
Those rejections in 2021 and then again in August 2022 must have been incredibly tough.
Extremely tough. But the crucial point, and we touched on this, is why they got rejected. It wasn't the drug itself. The clinical data for DefenCath held up.
It was manufacturing, you said.
Exactly. Issues at a third-party manufacturer, their CMO, and also problems with their heparin supplier. Critical issues, yes, but solvable manufacturing problems, not fundamental flaws with the product's safety or efficacy.
That distinction is huge.
Absolutely vital. And management's response, it was pretty textbook in how to handle a crisis like that under intense pressure. They were transparent with investors, which is always good. They worked hard to fix the issues with their existing partners. But the really smart move...
What was that?
They brought on a second alternate CMO, Alchemy, as a backup, created redundancy. That dual-track approach was key risk mitigation.
Smart. Didn't put all their eggs in one basket again.
Precisely. And the result, they got back in front of the FDA, resubmitted the application in May 2023, and got the approval that November. Just over a year turnaround from the second rejection. That shows real operational capability.
Yeah, that's impressive execution.
And one other point on management. The CEO's compensation in 2023 was actually below average for similar-sized companies. That suggests, his interests are pretty well aligned with shareholders.
Good to see. Okay, what about capital allocation? How are they using their money now? Their strategy seems pretty clear, right? Laser focused on DefenCath.
Textbook for this stage, yeah. Everything is geared towards driving DefenCath sales. So, building out the sales force, ramping up SG&A, sales and marketing spend. That's priority one.
And funding the R&D for those label expansions.
Exactly. The TPN trial, the pediatric studies, those represent the highest potential return on investment right now.
And no M&A talk. Not for them buying anyone else anyway. If anything, people talk about them being a target.
That's the chatter, yeah. They have a unique, valuable asset now.
And obviously no dividends or buybacks. They're plowing everything back into growth.
As they should be at this stage. Reinvesting in high-potential projects like TPN is the best way to maximize value right now.
Which leads to the big question. Is it working? Is that capital allocation effective? Let's talk return on invested capital, ROIC.
Right. ROIC is critical. It tells you how efficiently they're generating profits from the capital they've invested. For years, as you'd expect from an R&D company, CorMedix's ROIC was deeply negative. They were spending, not earning.
Makes sense.
But post-launch, it's done a complete 180. It's jumped into a strong positive range, somewhere between, say, 17% and 38%.
Wow, that's a dramatic reversal.
It really is. It shows that all that capital poured in over the years is finally generating very efficient, very profitable returns. And maybe the most telling sign of this shift is hitting positive cash flow from operations. $19.7 million in Q1 2025.
That's huge. It means they're becoming self-funding.
Exactly. Less need, potentially no need for raising more money through selling shares down the line. That shift from burning cash to generating cash, that's the hallmark, of one of those compounding machines just starting to get going.
A really profound shift. Okay, let's dig deeper into these numbers in Chapter 3, Financial Analysis. The inflection to profitability. So, market cap right now, around $922 million, puts them in that small cap space.
Correct. Still small cap territory.
And the revenue growth. You mentioned that J-curve. Talk us through that again.
Yeah, it's a classic biotech story. Basically, zero revenue, in 2023 and before. Then the launch kicks in. They did over $43 million in 2024, just a partial year, and the momentum is just building.
Over $39 million in Q1 25 alone.
Right. And now guiding for $62 to $70 million just for the first half of 2025, it shows that launch is really accelerating. Powerful momentum.
And the margins followed suit.
Dramatically. Gross margin is exceptionally high, around 96% in Q1. That's typical for a proprietary drug like this. Low production cost relative to price.
Okay.
But the big story is operating and net margins. After years of deep losses, they hit profitability in Q4 2024, $13.5 million net income. Then Q1 2025 was even stronger, $20.6 million net income. That's like a 53% net profit margin.
53%.
Yeah. It shows incredible operating leverage. As revenue scales up, profits are scaling up even faster.
And free cash flow, same story.
Mirrors it perfectly. They went from burning through cash, like $51 million negative FCF in fiscal 24, to that inflection point in Q1 25. Positive cash from operations, $19.7 million. That shift, moving from cash burn to cash generation, is probably the single most important financial development for them recently. Huge de-risking event.
So stability-wise, things are looking much better. Earnings turning positive, expected to grow.
Yeah, Wall Street analysts are forecasting pretty solid EPS growth, around 0.80 cents for this year, maybe $1.39 for 2026.
And the balance sheet sounds rock solid. Virtually no debt.
Pristine. Very clean balance sheet. Liabilities easily covered by assets, and specifically by a good chunk of cash, over $77 million in cash and short-term investments end of Q1.
Gives them lots of flexibility.
Maximum flexibility. And their current ratio, measuring liquidity, is super healthy at over 4.
And still no dividend, obviously. Reinvesting for growth.
Correct. No dividend expected anytime soon. Capital is better used fueling that growth engine.
Okay, so financially transformed. But what about valuation? What's it worth? This seems like a key point of debate.
It really is. You get this classic split depending on how you look at it. If you look backward, the trailing PE ratio is high. like 53 to 61 times earnings.
Hmm.
Compared to typical pharma or biotech averages, that looks expensive.
Right. Much higher than 2025x.
But, and this is a big but, CorMedix is right at the start of this massive growth ramp. So the forward PE, based on what analysts expect them to earn next year, is way more relevant.
And that's much lower.
Much lower, somewhere in the 9 to 17 range based on 2025 forecasts. That tells you the market is already pricing in or expecting very rapid earnings growth.
Okay, so backward looks pricey, forward looks more reasonable. What about intrinsic value, like a DCF?
Exactly. Discounted cash flow analysis tries to figure out what the company's worth based on all the cash it's expected to generate in the future, discounted back to today. Now, we're not building our own model here, but it involves making assumptions about revenue growth, margins expanding, cost of capital, all that.
Sure.
But one external analysis we saw from Alpha Spread ran the numbers and came up with an intrinsic value estimate of $26.78 per share.
$26.78, compared to the current price around $13.60.
Right. It highlights this potential significant gap between where the stock is trading today and what its long-term cash generation potential could be worth, assuming they execute on that growth plan.
Part 2, market dynamics, ownership, and the road ahead. Okay, so given this whole transformation story, what's the vibe in the market? Let's look at Chapter 4, market sentiment, a battle of bulls and bears. On the analyst side, it seems pretty clear-cut, right? Overwhelmingly bullish.
Yeah, the Wall Street consensus is definitely positive. You see buy or strong buy ratings across the board, maybe 6 to 11 analysts, depending on the source, and notably 0 sell ratings.
And price targets suggest decent upside.
The average target is up around $16.70 to $17.70, give or take. So yeah, implying meaningful upside from where it is now, around $13.60, though there's a pretty wide range in those targets, from maybe $13 up to $21.
And that recent RBC note, raising their target to $17 just a few days ago, reinforces that bullishness.
Exactly, citing the dialysis strength and that big TPN opportunity.
And the general news flow seems positive too, driven by them hitting their numbers, executing well.
Definitely. And that press release today, the expanded LDO deal and raised guidance, that's just pure positive catalyst material reinforcing the growth story.
Okay, but here's where it gets interesting. The short interest.
Ah, yes. This is the fascinating contrast. While analysts are bullish, there's a significant number of people betting against the stock. Short interest is high, around 12.7% to nearly 13% of the float.
13%, that's substantial.
It is. It means a lot of market participants think the price is going down, and the days to cover is over 9.
Meaning it would take shorts over 9 days of average trading volume to buy back all their borrowed shares.
Correct. That creates this really tense dynamic. Any strong positive news, like today's, could force shorts to cover quickly, buying back shares and potentially fueling a rapid price spike, a short squeeze.
So CRMD is kind of a prime candidate for that.
Given the high short interest and the positive fundamental momentum, absolutely, it's a situation worth watching.
And what about the technicals, the charts? Do they support the bullish fundamental story?
They really do seem to confirm the turnaround, yeah. The stock price, $13.61, is comfortably above its key moving averages. It's above the 50-day average, which is down around $11.50. And crucially, it's well above the 200-day average, which is sitting closer to $10.
Those are classic bullish signals, right?
Yeah.
Trading above the moving average.
Classic bullish signals. Strong upward momentum. And interestingly, that decisive move above the 200-day average happened back in early 2025, right around the time DefenCath really launched and the company hit profitability. The chart seems to be validating the fundamental story.
Okay, interesting dynamics there. Let's move on to Chapter 5, ownership structure. Who's at the table? Who actually owns CorMedix shares? Having significant institutional ownership adds credibility, doesn't it? Means the big money managers have looked under the hood.
Absolutely. Around 40% of CorMedix shares are held by institutions. That tells you it's passed some pretty rigorous due diligence screens.
And who are the big holders? Any familiar names?
Oh, yeah. You've got BlackRock with about 4.7 million shares, Vanguard with around 3.6 million.
The giants.
Right. And Elliott Investment Management also has a significant stake, about 2.4 million shares.
Elliott. They're known for being quite active, aren't they?
They are. And what's notable is that you see firms like Elliott, First Turn Management, BlackRock, the smart money really building their positions after the FDA approval came through.
Ah, so they weren't just betting on the approval event. They're investing in the commercial rollout.
That's what it looks like. Investing in the long-term growth story, not just the regulatory outcome.
What about insiders? Management, directors?
Insiders own about 4% of the company. Not a huge percentage, but their recent trading activity is telling.
How so?
Well, the CEO, Joe Todisco, has been a consistent buyer of the stock on the open market. He bought shares back in September 23, again in March 24, and acquired a big chunk through options in April 25.
Open market buying, that's usually a strong signal, right? Selling can happen for lots of reasons, but buying...
Buying usually means one thing. Insiders think the stock is undervalued and likely to go up. It's a real vote of confidence from the person who knows the company best. Shows deep conviction.
Okay. So good institutional backing, positive insider signals. Ownership seems reasonably well spread out.
Yeah, decent public float for liquidity. The
Right.
concentration among those top-tier institutions adds stability, and having someone like Elliott involved suggests a major shareholder keenly focused on maximizing that long-term value.
All right, to get the full picture, we need that balanced view. Let's do a quick SWOT analysis in Chapter 6, Risk Assessment. A comprehensive SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, starting with strengths, the big one. That market monopoly. First and only FDA-approved product for this specific use. That's protected by that formidable moat we discussed, 10.5 years regulatory exclusivity. Patent out to 2042.
Got it.
You've got a management team that's proven they can navigate major setbacks successfully and financially. Pristine balance sheet, profitable now, cash flow positive, virtually no debt. Plus, a super high margin product giving them great operating leverage.
Okay, clear strengths. What about the weaknesses? The most obvious one has to be the single product dependency, right? Everything rides on DefenCath.
Absolutely. That's the biggest internal risk. Any unforeseen issue with DefenCath would hit them disproportionately hard.
They're also still relatively new to the whole commercialization game at this scale. So there's execution risk, scaling sales, logistics smoothly.
True. They need to prove they can manage that rapid growth efficiently.
And while they are profitable now, the track record is still short. Only a couple of quarters after years of losses.
Fair point. Consistency needs to be demonstrated over a longer period.
Okay. Opportunities. We've touched on these.
The big one is label expansion, TPN and pediatrics. That could realistically more than double their addressable market using a product that's already approved. Huge potential leverage there.
Makes sense.
And because they're now de-risked, profitable, with a unique asset, they become a much more attractive M&A target for a larger pharma company.
Right. Acquisition potential.
And don't forget international expansion. DefenCath is already approved in Europe, just under a different brand name, Neutralin. That pathway exists for future growth too.
All right. Finally, threats. What external factors could derail things? Reimbursement has to be high on the list, doesn't it? What happens after those temporary government payment programs run out?
That's a key uncertainty. Long-term profitability really hinges on securing favorable, sustainable pricing after things like the TDGA period end. That's an ongoing negotiation.
They also still face that competition from the status quo, right? Inertia is powerful.
It is. Cost concerns or just resistance to change might slow down adoption versus those cheaper, even if inferior, off-label options.
Yeah.
They need to keep proving the value proposition.
And then the usual macro stuff. Inflation, interest rates.
Yeah, those headwinds are always there. Inflation could pressure margins or impact pricing via government policies like the IRA. Higher interest rates affect valuation models and potentially M&A. Geopolitical risks, too, like tariffs on heparin, though their dual supplier strategy helps mitigate that supply chain risk somewhat. Management's proven ability to handle supply crises is a plus there.
Okay, that gives us a good 360-degree view. Let's try to pull it all together in Chapter 7, Conclusion. Synthesizing the bull and bear cases.
Right, so summing up this deep dive, CorMedix is clearly at this powerful inflection point. The whole investment story boils down to a really compelling set of bullish arguments versus a pretty concise list of legitimate bearish risks. The bull case rests on that decade-long government-backed monopoly with DefenCath, tackling a serious, unmet need. They've made that incredibly difficult transition from risky, cash-burning R&D outfit to a profitable, cash-generating commercial business. That dramatically de-risks things. Pristine balance sheet helps too. There's a very clear, very probable path to potentially doubling their market through TPN and pediatrics using technology that's already proven and approved.
That label expansion is key.
Absolutely. And you've got a proven management team leading the charge, with the CEO putting his own money on the line through open market buys, signaling real conviction.
Okay, that's the bull case. Now, the bear case. Still boils down to that single product dependence, doesn't it? If anything goes wrong with the DefenCath, it's game over almost.
That's the core risk. Any unforeseen issue has an outsized negative impact.
And the current valuation, especially that trailing PE, it already assumes a lot of future growth is going to happen. Any stumbles
Could lead to a sharp correction. If they miss expectations, the market might not be forgiving given where the multiple is.
long-term profitability still depends heavily on getting that reimbursement sorted out after the temporary programs end.
That's a major hurdle they still need to clear definitively for the long term.
And finally, that high short interest. It shows a significant chunk of the market just remains skeptical they can pull it all off.
It's a constant reminder that not everyone is convinced by the bull story yet.
So, the valuation summary again. Expensive looking back, but potentially cheap looking forward.
Exactly that dichotomy. Trailing PE looks high, but forward PE is reasonable, and that DCF analysis we mentioned, like the $26.78 estimate, suggests significant upside potential if the growth story plays out. It hinges on execution.
So the concluding outlook, as of today, June 23rd, 2025, CRMD presents this really compelling case study, doesn't it? Growth versus value, maybe. The current share price, around $13.60, seems to reflect this balancing act. It acknowledges the recent success, the strong market position, but also prices in some of those risks around execution and future trials. Our deep dive suggests that while the stock has run up, it might not yet fully capture that long-term earnings power, especially if TPN becomes a reality. So it leaves you, the listener, with a classic investment decision, really. Is the market being short-sighted, focusing too much on the high historical PE and the single product risk?
Or is it underestimating the true long-term value of what CorMedix has built? A new, profitable, defensible monopoly with a clear path to significant further growth. And just a final thought for you to chew on. Think about that J-curve we saw in their financials. What does it really take for a company to go from pre-revenue biotech facing all those hurdles to a profitable cash-generating machine? And what can that teach us about spotting potentially hidden value elsewhere in the market, in those corners that maybe everyone else is overlooking right now? If you found this deep dive valuable, please do remember to like and subscribe to the Stock Analytics AI YouTube channel. And check out our membership for just $4.99 a month. Members get priority deep dives on the tickers they request. Plus, over the next few months, we're diving into all the S&P 500 stocks, and members get exclusive priority access to those deep dives. As always, remember, this analysis was generated by an AI system. It's for educational purposes only, and definitely should not be taken as financial advice. Always do your own research or talk to a qualified financial advisor before making any investment decisions.